Unfortunately, a lot more withdrawal plans fail than we think, and it's because of a few common mistakes that people make every year. So in today's video, we're going to run through a few of these errors and, more importantly, how to avoid them. I'm able to share this knowledge because over the past 12 years, my company and I have helped hundreds of clients build and plan their dream withdrawal strategies. And I know how hard it can be to build a plan that prepares you to handle future risks and also allows you to achieve your retirement goals. Now, it can be easier than most people make it. The problem with most withdrawal plans is that the advice they get online just isn't tailored to their own situation, leaving them overexposed to risk that they didn't realize. So in this video, I'm going to share with you the true reasons why most withdrawal plans fail, when they fail, and how you can avoid these mistakes yourself. So let's get into it. Reason number one is not having a plan that adequately addresses market volatility. What is sequence of returns risk, and how does this, along with market volatility, impact your ability to pay yourself that steady monthly income from your investments over the years without the fear of you running out of money? Sequence of returns risk is a different kind of risk than the risk that you have when you own a stock. When you own a stock, you have the risk of losing money. But with the sequence of returns risk, you have the risk that comes from a lottery of returns. It's the risk that the order of returns that you receive in your portfolio is unpredictable. Sure, you might average 8% or 10% per year over time, but that means that you're going to include years with 2%, negative 5%, positive 15%, negative 7%, just to get the average. This series of order of returns that you receive is exactly what we're talking about when we say sequence of returns risk. If you're creating a retirement plan, you might be tempted to think that your average return is 8%. And because you're withdrawing, say, 6% per year, that you would never run out of money. And that would be true if your returns were steady throughout the entirety of your 25 to 30 years of retirement. A popular website for financial planning nerds like myself is kitces.com, and on their site they provide a line graph showing that an 8% return could sustain a 6% annual withdrawal, plus allow for that inflation adjustment increase of 3% per year. But that's perfect world math, and as you correctly assume, we can't achieve perfect world math. We have variable returns. So in the real world, we get different returns each year. And if those early years of retirement have a favorable sequence of returns, something like positive 5, positive 8, positive 12, and then maybe negative 3%, it's going to look much better for you than if those early years occur as a negative 5, negative 8, and then maybe a negative 12 before you get a positive. To show you a good example, a perfect disaster really, let's look at this set of numbers. You see, these numbers are hypothetical. They don't represent any specific investment or strategy. But here we have a 6% withdrawal represented by a $60,000 withdrawal, and the first 3 years are negative 9, negative 12, and negative 22. Just 12 years later, $1 million is almost completely eliminated. This is why the 4% rule was developed. The 4% rule was the answer that came back when a financial planner asked the question, what is the largest percentage that we can spend from our portfolio each year and have a very low possibility of ever running out in the most severe of environments? Now, I'm oversimplifying this, but that was the gist of it. 4% was the answer to the question, and taking 4% from your portfolio is a flawed answer for many reasons that I'm not going to go into in this video, but it did solve for one important thing, and that is it gave us something to use to help with the sequence of returns risk, and that counts for something. But I will mention one of the challenges to the 4% withdrawal rule. The shortcoming is really double-sided. On the one hand, it can cause you to misinterpret how much you really need to retire because you estimate you'll be taking less from your portfolio each year. And on the other hand, when you do retire, it can cause you to underspend in retirement when maybe you don't need to. The 4% withdrawal rule is imprecise, and not only is it imprecise, but it's difficult for retirees to follow in practice. because they feel like they're flying blind. After a few years into retirement, stock market sequences have a scary year or two. The retiree tends to look for evidence that they're going to be okay throughout the volatility, and the only thing they can do is reference a study that was done over 2 decades ago. And that feeling of flying blind can make it difficult to stay committed to the plan. They might look at the often utilized Monte Carlo dial, but there's a glaring problem with that too. If their dial says that they're 100% successful, they might feel good about that, but this also means that they could be spending more money in retirement. Let me explain. 100% success means that out of 1,000 Monte Carlo tests, you were able to reach all of your goals without having to adjust your spending. But this also means that there were 100 versions of your plan where you could have enjoyed more spending and still be 90% successful. So if your plan says you are 90% successful, that means that you have a 10% possibility that you would need to adjust your spending sometime during your lifetime. Now that certainly seems less scary than saying you have a 10% chance of being completely broke. There really needs to be a better way of framing your retirement success other than communicating to a retiree that they're shooting for 100% success. That really doesn't tell them what they need to know. That communicates pass, fail, and retirement is never pass or fail, it's adjust. So we found that people need something better than these sort of blunt tools to help them feel more grounded in their withdrawal strategy. My personal opinion is that something like a guardrail system works much better. Modern guardrails is a term that I use because I don't want you to confuse it for the more primitive version of guardrails. You see, there is an original version of guardrails that promises easy rules to follow and an increased spending amount that's over the 4% rule, but in reality, those guardrails have fallen short. Modern guardrails is more sophisticated. It's completely different than the primitive version. If you've never heard of guardrails before this, then just ignore what I just said. So here's what modern guardrails are and why I think it's better to address the sequence of returns risk. Okay, so follow me here. The 4% rule is based on having a rate that's low enough to cover all bad possibilities that could happen even during the worst times. So I'm going to give you 2 truths. Truth number 1, most retirees are not going to suffer the worst times. Some will, but most won't. The only reason we say to spend 4% is because we don't know as retirees if we're going to retire and the world is going to be great for the next 10 years in a row, or if it's going to be like the 1960s stagflation period. But we could spend more than 4% if we had a system that notified us of our retirement spending and if it was jeopardizing our goals. So truth 2 is modest adjustments to spending can preserve almost any retirement portfolio. So guardrails can monitor your withdrawal strategy, and modern guardrails can use the sophistication of the Monte Carlo probability dial, but frame it in a better way than probability percentage of success. So instead, it can frame it like this. Here, the Monte Carlo is showing the retiree that 90% of the scenarios resulted in spending that was greater than when they began, and the plan spent 39% more than planned. And 10% of the scenarios resulted below the planned amount, with the average spending being 4% below planned spending. This hypothetical retiree agreed to a plan that requires the willingness to adjust income down if necessary in exchange for a larger than 4% initial withdrawal rate. Here's another image of how you can use the benefits of Monte Carlo probability testing but reframe it in a more helpful way using guardrails. So this withdrawal strategy is showing that on average the retiree would have been recommended to increase spending every 2.1 years on average, and a decreased spending happened every 35.6 years. So most of the decreases were between 0.5% and 8.4%, with the largest and worst decrease happening at a reduction of negative 15.6%. Now you might think that the pros and cons of a withdrawal strategy like this, like guardrails, would be that maybe the pros are that you can spend more money, but the cons are that you'll have a variable income in retirement, and that's not true. Instead, you have a steady monthly income that adjusts with inflation, and when an upper guardrail is reached, you get to spend more than you originally planned. Or if a lower guardrail is reached, you reduce your spending to allow for your portfolio to recover. And these guardrails are set within a range. The more aggressive they are, the more likely a lower guardrail would be more frequently reached. The more conservative, the less likely and less frequent. In my opinion, every person can get a more clear picture about their withdrawal strategy plan with these modern guardrails. If you find this interesting and you want to hear about how you can optimize your retirement plan in general, and at the end of this video, click the link in the description to watch another video free of charge where I break down in full detail an entire retirement playbook where I discuss everything from taxes to income and healthcare. All right, reason number 2. Inappropriate asset allocation leading to poor results from withdrawal plans. Your asset allocation refers to how you have your investment portfolio divided up amongst different asset classes. The highest and most rudimentary level of division would be how many equity stocks do you have as compared to bonds. You zoom in a little bit closer and you'll see that those stock equities could be categorized in terms of their market capitalization, so small cap or large cap. It can be looked at in terms of type, such as value versus growth. And it can also be real estate or commodities or foreign companies versus domestic. Your asset allocation is important when it comes down to your retirement withdrawal plan because how you're allocated impacts how your portfolio behaves and its return. For example, a well-rounded portfolio will be less volatile than a portfolio that is more focused in fewer asset classes. The 2 most common mistakes near retirees make when it comes to their portfolio allocation are they either are overly conservative or they're over-focused in large cap, which is pretty much dominated by technology. So in one scenario, we're not getting enough returns to help our retirement withdrawal plan over the long term, or in another scenario, we're getting those returns that we want, but we're way too volatile. This too creates problems for your withdrawal strategy. If you have an overly aggressive technology-filled portfolio, that might be okay during your accumulation years, but the high volatility, otherwise known as standard deviation, creates problems when you're taking that money back out for spending in retirement. So it's been said that what happens during your first few years in retirement spending can sort of be like the lottery in terms of how well your withdrawal strategy does overall. So let me show you what I mean. I'm going to show you 2 sets of numbers. One set of numbers is going to have positive returns in the first 5 years, and the other set is going to have a few negative years during those first few years. Now, before I show you this, let me point out a few things. First of all, this is a hypothetical illustration, so it doesn't represent any specific investment. You're also going to notice that the returns are the same, they're just flipped, meaning the average return is the same, just the order of returns is different. So the only difference is the order of withdrawal. Now, one set of numbers has a bad start to retirement, while the other has those negative numbers at the end of retirement. So the first thing you'll notice is that there are 5 negative years out of 20. Those are shown in red. And in the first example, those first 3 years have negative returns happening during those first several years. And in the second example, the first 3 years are positive, placing the negative, -9, -12, and -22 at the last years. Both are withdrawing $50,000 per year from a starting portfolio of $1 million. Lo and behold, 20 years later, the first portfolio ran out of money while the second portfolio has over $700,000 left. Notice they both have the same average rate of return. So this is an example of why average return is not always what it seems. Volatility matters, and your portfolio allocation is closely related to your volatility. And as I've said, your investment allocation plays an important role in your withdrawal strategy. And research on how you should be allocated has changed in recent years. The traditional allocation that you may have heard of is referred to as the rule of 100. Simply put, you take either 100 or 110, you subtract your age, and the result of that would tell you how much risk you should have. So as an example, if you are 65, then 100 minus 65 means you'd only want 35% of your portfolio to be located in stock equities as compared to bonds or cash. Now, this rule of 100 is an easy way of explaining what we call a declining equity glide path. Equity declines as we get older. However, this is no longer the thinking thanks to long periods of lower interest rates, longer lifespans, and inflation. New studies show that a rising equity glide path can be more beneficial. Again, I'll quote the work of Michael Kitzes and Dr. Wade Pfau, and they've published extensive work on the idea that as we get closer to retirement, we want to protect ourselves, especially during those first years of retirement. then we want to be increasing or at least maintaining a healthy amount of equities rather than too much cash or bonds. So in other words, referencing ourselves back to the two sets of numbers we just looked at, in the first set, if they would have protected those first 5 years or so and maybe not suffered those deep declines, the situation would have been much better off. So in general, what you want to do is you want to try to eliminate or reduce extraordinarily large losses in the early parts of retirement, but you want to maintain a commitment to a rising equity glide path over time. So here's what you can do. First, you want to identify if your financial plan has you spending larger amounts of money early on in retirement. This means that you would be more at risk of having these unfavorable negative sequences of returns. So two examples of how this might apply to people. Example number one, family paying off an RV for the first 5 years of their retirement, and they're spending 8% of their total savings each year. Example number two, we had a mother wanting to help her son buy a condo during the first few years of her retirement. And so what we did is she set money aside in a CD. So after identifying if you are especially at risk during your early years, next, you want to create a plan for those first few years. You could set aside a few years of cash. You could buy a short-term annuity. You could set your allocation overly conservative for the first few years with the plan to increase that allocation maybe 3 years or 5 years or 7 years into retirement. So you'd be conservative and then you would become more aggressive later. Or you could just use a system like the modern guardrails that I mentioned. That has a built-in way of smoothing your income out while keeping your long-term goals in mind. Okay, reason number three, failing to plan for unexpected changes in taxes and inflation. People who are retired face additional complications to both their tax situation and also inflation. With inflation, the challenge is that when we're working, our incomes would most likely go up because our career path would just give us a raise every year through work. But now that we're retired, we're in charge of our inflation increases. And with taxes, we go from having ordinary income tax and maybe capital gains taxes to having the added complication of income from our IRAs, Social Security taxation, and there's indirect layers of tax punishment because our income might cause us to pay more for Medicare than what our neighbors might be paying. In other words, there can be tax surprises that cause us to spend less. And the more money that goes out in taxes, the less we get to spend in retirement. The two most common mistakes that we see are, number one, with inflation, people don't prepare enough of an adjustment to keep up their lifestyle. And number two, with taxes, people are clueless about how the tax traps work, and so they fall into them. I'm talking about the tax trap caused by required minimum distributions when they turn 73 or 75, the tax trap of slipping into the Medicare IRMA brackets, and the tax trap caused by phantom Social Security taxes. And when you get these estimates wrong in your retirement, it always means that you end up spending less. And if you're a person whose retirement plan is a little bit uncertain, being told that you get less net income to spend in retirement isn't just an inconvenience, it's affecting how you live in retirement. Listen, we want our plans to be as strong and as accurate as they can be because any change in the tax laws in the future to income tax rates can significantly reduce the net income available to spend. We can't control the future of what can happen, but we can do our best to be tax smart. We can't change how inflation will go, but we can do our best to plan for it so that the most significant risks are reduced. Things like having our essentials covered. So here are three things anybody can do. First, we can incorporate inflation-adjusted withdrawals into our strategy by using just about any decent withdrawal strategy. As I mentioned earlier, I like the modern guardrail strategy, but even the 4% rule has an increase for inflation. Next, we can use tax-efficient withdrawal strategies, things like managing the order of withdrawals from your accounts and engaging in forward-looking tax planning strategies. One of the most important things is to have your advisor create that income tax projection for the upcoming year before you create your income as a retiree. And third, we can adjust our allocation to best fit your withdrawal strategy. I prefer protecting the early years in retirement and increasing that equity glide path as you get older. So now you know the exact reason why most withdrawal plans fail and how you can avoid making these simple yet common mistakes. However, withdrawals aren't the only problem area that I see retirees go wrong with time and time again. So if you want to learn how to avoid the other common retirement mistakes in areas such as taxes, investing, and healthcare, click the link in the description to watch another video where we break down a complete retirement playbook. See you in the next video.